We're seeing huge inflows into the ETFs. Massive demand for silver. And I think it probably is the most undervalued asset on the planet. That means that the physical metal is actually changing hands. Now, in terms of how much is leaving the exchange, a lot. Not all of it, but a lot is actually leaving the exchange.
Silver is definitely on a tear, and it's going to go considerably higher. As far as gold is concerned, it's just been consolidating sideways. It's extraordinary how it's just moved sideways for the last, 2-3 months, consolidating and really providing a platform for the next rise up.
You got a dumping of silver stocks, which had made new 52-week highs as silver went up. And then, of course, it's very weak hands in the gold and silver mining stocks.
In today's explosive episode, 3 of the sharpest minds in the precious metals complex, Andy Schectman, Peter Schiff, and Alasdair Macleod, sound the alarm on what they believe is a looming economic storm. From the crumbling foundation of fiat currencies to the silent accumulation of gold by global power players, they expose the cracks in the system that mainstream media won't touch. If you're still trusting the dollar, this episode may shake your confidence. They also reveal their bold price predictions for gold and silver as the world edges closer to a monetary reset. If you think the dollar is safe, think again. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. More importantly, check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and multiply your ounces without taking any fiat risk. Let's get back into the episode.
Talked about how significant the deliveries have been every single month. It's not an anomaly anymore. I mean, if you look at the COMEX delivery numbers, you go back to November, but look at them and they're extraordinary. Someone or some institutions have a very, very strong desire for physical delivery. So far, just through the first 3 days of the August contract, we saw 20,126 contracts stand for delivery. That's just in the first 3 days. That's let's just do the math. 20,126 times 100 ounce bars. So let's do that math here. 20,126 times 100, 2,012,600. Let's just call it times 3,400-ish. That works out to $6,842,840,000 worth of gold in the first 3 days of the delivery contract. Silver, this is not a major delivery month for it. We saw 1,064 contracts worth about just over 5.32 million ounces of silver. Each contract's 5,000 ounces. So again, in platinum, 1,006 contracts. Yes, that's 50,300 ounces. Each contract is 50 ounces. What's really significant, and these are very significant early numbers, especially with gold, seeing huge delivery volume in the month already. Well, this suggests strong demand for physical. And what's really interesting is so far, every contract that has been issued is settling in physical metal, indicating the real demand. And it's like a 1-to-1 ratio. This is significant because you rarely see that happen in COMEX. I've mentioned that to you in years before that, futures contracts are usually closed out before delivery. They're traded for profit or settled in cash. When contracts are stopped, which is what the lingo they use, that means that the physical metal is actually changing hands. Now, in terms of how much is leaving the exchange, a lot. Not all of it, but a lot is actually leaving the exchange. And August is one of the major months for gold, and you typically see higher open interest in delivery volume. But the strong intent to take physical metal where every single contract has been stopped, meaning buyers aren't shutting their positions, they're taking delivery. This is ridiculous. I mean, it's huge. But this is exactly what we've been seeing, the delivery volume and the vault withdrawals, the loadouts it's called. There's been steady outflows, suggesting that loadouts are occurring relative to deliveries more so than ever before. And so I think it's really, really important. It's not a one-to-one, but it's pretty damn close. And so silver supply, same thing. You know, we're seeing huge deliveries. This isn't a primary delivery month for silver, but still huge delivery, and they're leaving. We're seeing huge inflows into the ETFs. Massive demand for silver. And I think it probably is the most undervalued asset on the planet. But gold is getting the spotlight. Silver's kind of in the shadows. I just think that, look, we've talked a lot about what's going on behind the scenes, where China is quietly stockpiling both gold and silver through unofficial channels, enabling it to purchase silver without affecting the silver spot market. I think that's really where the mystery is, how much silver is being accumulated by countries like China. I think they're making a specific drive to accumulate stuff off exchange, even though we are seeing a lot of deliveries because it's a smaller market. They're trying to keep it, I guess you could say, less apparent to the rest of the world what they're doing. So no, it's amazing the amount of gold that's been delivered in just the first 3 days. But this is what we've been talking about now every month since the beginning of the year, and it's showing no signs of slowing down. In fact, it's showing signs of increasing.
In today's news headlines, gold remains attractive as investment demand surges, says top bank. UBS has reaffirmed its positive stance on gold, rating the metal as attractive, even as prices sit near all-time highs. The precious metal has outperformed all other asset classes in 2025, rising 29% since the start of the year, comfortably ahead of equities, bonds, and even Bitcoin, according to UBS strategists. In its latest note, UBS set a target of $3,500 per ounce by the end of the year, with a possible upside to $3,800 if geopolitical or economic risks escalate. The World Gold Council's recent demand data showed investment demand surging 78% year on year in the first half, led by inflows into exchange-traded funds and strong bar and coin buying, particularly in China. UBS now expects full-year exchange-traded fund demand just above 600 tons, the strongest since 2020. Total demand is forecast to reach 4,760 tons in 2025, the highest since 2011, despite jewelry consumption falling as buyers turn to lighter pieces or alternatives. Central bank purchases have slowed slightly but remain well above historical averages, with 43% of surveyed reserve managers planning to increase gold holdings in the coming year. UBS recommends a mid-single-digit allocation to gold for portfolio diversification, adding, hedges remain a vital component of any well-diversified portfolio. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
So I would expect to see gold drift off a little bit, but I mean, we're talking, 1-2% sort of thing. I mean, this is not meaningful in the scheme of things. The other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold. It is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So anyone who thinks that there is going to be a decent reaction in gold and they're going to be able to get into it and all the rest of it, I think they're going to miss it, I'm afraid. And that's the way it is. It's very underowned. I mean, if you look at the other way of looking at this is and this is gold, admittedly, but it's estimated that total portfolio assets around the world, global assets, are in the region of, I think the 2023 figure was $270 trillion. if you look just at the ETFs, that represents less than 0.2% of that. I'm talking about global ETFs. Now, the reason I would say ETFs is that in most of the world, in terms of portfolios, you have got investment regulation, and gold is not a regulated investment. So it's actually quite difficult for an investment manager to put raw gold, physical gold, into a portfolio, because he's got to argue the toss with his compliance officer. And, do you want to do that? No, you don't. So what you do is you buy a gold substitute. That is why I think that the gold substitute in the form of ETFs, which is a regulated investment, is a fair indication of the level of gold interest in portfolios. Now, obviously, there is an element of wealth, and a fairly large element of wealth, like say a larger element of wealth than ETFs, privately held as private wealth, not part of, if you like, the sort of regulated investment scene. So it's not recorded, if you like, in ETFs. But nonetheless, that's very concentrated in Asian hands. We know that. But when it comes to US, when it comes to UK, when it comes to EU, and when it comes to, our friends in Australia and Japan and so on and so forth, gold is very underowned. So if you get some sort of crisis and a flight into the dollar, which is what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. So this is why I feel the downside in gold is very limited. And, of course, the other thing is, and this is desperately important, it's not so much the gold price has been rising, but the dollar has been falling. And so much so that we've even seen this in the trade-weighted index. So, in short, there is a lot of catching up to do. And I think it's all part and parcel of the swan song, if you like, of fiat currencies.
Now, Peter Schiff does a deep dive into the recent news on Trump's tariffs and how everything relates to the gold and silver prices moving forward.
Coins are not going to save the dollar because they don't increase the appeal of the dollar. People are saying, well, everyone's just going to use these stable coins in global commerce, and so that's going to create a need for the dollar. They're not going to use these coins. If the world is de-dollarizing, then they're going to de-dollar stablecoin too. They don't care. They don't care how you wrap up the dollar, what kind of fancy packaging you want to put around a dollar. At the end of the day, it's still a dollar. And if I don't want the dollar because the U.S. is running huge budget deficits and huge trade deficits and imposing these tariffs, then why the hell am I going to want a U.S. dollar stablecoin? I am not. Ultimately, the way crypto is going, the way this thing ends up is if you want a stablecoin, you can't have a US dollar coin because it's not stable, because there's no stability to the dollar, right? Why do you want to hitch your boat to a sinking ship, right? You're going to sink with it. It makes no sense. So if you really want a stable coin, you need something stable to anchor it, and that's gold. And there's no talk about that, but that's where the stable coin should be headed. Gold-backed stable coins, tokenized gold. That makes perfect sense. To tokenize US dollars makes no sense at all. What is the benefit of that? What is the benefit of holding a stable coin and earning no interest? Hell, I could put my money in a money market fund and earn 4.5. Why do I want to put it in a stable coin and earn nothing? I've got plenty of liquidity in my money market. I could write checks. I could send ACH transfers. I could use my debit card. I could fund a PayPal or Venmo or a Zelle. Why the hell would I need a stable coin and give up all that interest and let the issuer earn all the interest instead of me? Makes no sense. The main purpose of stable coins is to trade crypto, to trade Bitcoin. I don't care about trading Bitcoin because I don't trade it. So why do I need a stable coin? But I can see the benefit of a stable coin backed by gold, because there, right, it's not easy to use gold as a medium of exchange the way it is dollars. But if you tokenize it, it's very easy. Now, gold can be held by a custodian who can issue tokens. And now we can use those tokens to buy and sell stuff. We can use it as a medium of exchange. We can make instant payments around the world at basically no cost, or practically no cost, at the speed of light. So there is a viable reason to tokenize gold. And gold's not really paying interest anyway. So if I'm going to store my gold and I'm not going to earn any interest, well, why not store it in a stable coin where I don't earn any interest, but I get all the added convenience? I mean, that's how all the crypto people are constantly criticizing gold, because they say, well, you can't use it to make payments. Oh, yes, you can. I mean, you could use it even without tokenization. But yes, I agree. If I want to buy something from somebody in Indonesia tonight and I want to pay for it, I can't really send them some gold physically. But if I had a gold token, a token that was issued that I can then transfer to that person in Indonesia, and I can transfer the ownership of the gold that never moves, right? That's the same concept as a stable coin backed by U.S. treasuries. The treasuries don't move, right? The dollars don't move. What moves is the token that corresponds to ownership of those treasuries, of those dollars, not really the treasuries, because you don't get any interest, but the dollars that are there. I can do the same thing with gold, but that makes sense. So we can conduct global payments in US dollars, in gold, with tokens that are tied to and back to gold. So that's what makes sense. That's what nobody is talking about other than me.
What did you think of today's episode? Do you agree with the experts, or do you see things differently? Let us know in the comments, and we read everyone. If you haven't subscribed yet, now's the time. We bring you hard-hitting conversations like this every week, and don't stop here. So check out this video right here. It's the perfect follow-up and dives even deeper into the topics we covered today. I'll see you on the other side.